So Coreweave has been making the news lately pretty much for all the wrong reasons. Their stock is down almost 27% in the past 5 days. But some people are asking whether or not this is a buy low opportunity considering what Coreweave does. So we're going to take a look at that. Now, if you're not aware of what Coreweave does, which I wasn't even fully aware, they are a specialized, rapidly expanding AI native cloud computing provider, and they build and operate large-scale data centers designed specifically for high-performance AI workloads. So they provide on-demand access to top-tier NVIDIA GPUs, serving AI developers, labs, and major enterprises like Microsoft and OpenAI. So you're like, okay, that sounds pretty good. That sounds like they are positioned well for this AI future that we have seen the beginnings of. Now, unfortunately, they have had some bad news lately. So not only did their stock fall over 18% in late February and early March, but they had some earnings issues, and they also have some legal and risk factors. Several law firms have announced class action lawsuit investigations into them, which obviously did not help things either. But they do have NVIDIA as a major investor and partner, so that is a good thing to go with the bad. Now, some things to look at here. They do have a loss over the past 6 months, as well as obviously a rough start to the year. Really kind of started around the end of October and early November. Their stock started to plunge. So in the past year, they are still positive. Over the past year, they have actually outperformed the S&P 500 at 84% compared to about 16.5%. So by a significant margin. If you look at the S&P 500 over the last 5 years, they are up about 77%. Coreweave over the past 5 years is up the same, about 84%, because they don't actually have 5 years of data or as a publicly traded company yet. Now, some other things I wanted to point out about Coreweave. One is you'll notice that they don't have a PE ratio mentioned on here. And if you look at Robinhood, you'll notice that sometimes they have a PE ratio that's different from Google. Well, they have a negative 30.76 PE ratio on Robinhood. So neither one is what you are looking to see. PE ratio is only one small indicator, but that led me to believe they must not be profitable. And apparently, they currently are not consistently profitable despite rapid revenue growth. They reached 5.13 billion, but the company reported a widened net loss of 452 million in Q4 of 2025. So they have intense capital expenditures, like 8.2 billion in capital expenditures in Q4 to build AI data center infrastructure. That's big. That's one of the biggest problems with this whole AI movement is how expensive data center infrastructure is. So they're not profitable. They don't give you a dividend. Their quarterly financials, their revenue is up in their most recent Q4, but net income is down, diluted EPS down, net profit margin is down. On their EPS and revenue, they missed on EPS by 13.48%, which is pretty significant. Revenue, they did beat by 2.89%. Over the last 4 quarters, they've missed on 3 of those for EPS, which isn't a great sign. So return on assets and return on capital are both negative, also not a good sign. And again, they are in fact not profitable. So that's not helping any of their numbers right now. If you look at their assets versus liabilities, it's very close, almost a tie between their assets and liabilities. I usually like to see at least a 2-to-1 ratio, and it's nowhere close to that. Sometimes I look at the last 3 months on Robinhood because that gives you an idea of how they're doing over the past equivalent of a quarter, and they are still down 2.85% over the past 3 months. You do see some users on Robinhood buying up some Coreweave a little bit, but it's kind of split over the past few weeks. If you look at hedge funds, they are kind of split, but a lot of selling over the past few quarters, although the most recent one was much closer, 43% buy, 57% sell. And then if you look at insiders, I mean, it's pretty even across the board for the most recent months. As far as what Wall Street analysts are saying, according to 31 analysts, they have a 54.8% buy score, which is, again, just barely over half of them agreeing that you should buy or that they believe people should buy. 41.9% hold score, and 3.2% sell score. So not really the most confidence in the world for Wall Street analysts, but they're not necessarily saying it's time to sell. If you look at their earnings chart, they are all over the place for earnings. I mean, obviously they beat on a few of these. Earnings has not necessarily been their biggest problem, but profitability has been a big problem, and seeing the returns they need to see. Do you believe they're going to get that or not? Nvidia seems to believe that, and that's a pretty strong partnership to have. But if you had stock in them and you're seeing it just free fall, how long are you willing to hold for something like this that sounds like it's positioned well for the future? Now, if as far as their EV to EBITDA ratio, they have a 27.28 current EV to EBITDA ratio. If you look at where that is ranked, it is ranked worse than 72.94% of software industry stocks. If you look at their forward PEG ratio, you can't even really look at that either because they are not profitable, so therefore they have a 0. As far as what their leadership looks like, they seem to have decent leadership according to their employees. They have a 3.7 out of 5-star rating from their employees. More than half of them recommend working here to a friend at 63%. And they have an 89% approval rating of the CEO, which is quite high for Glassdoor reviews. All that being said, I don't really like investing in companies that aren't profitable and are consistently missing on EPS. Although I do believe that what they are doing and their partnership with Nvidia is a good sign. You know, the class action lawsuits, that's typically not. I'd like to see how that plays out first as well. So for me, I would be out. I get why some people, I mean, the argument for buying would be that it's low right now and they've had some massive earnings. They have a partnership with Nvidia. So that would be the argument for whether you should buy it. If you're trying to make an argument for holding, again, you already have it and you're like, well, I don't know if I really want to sell it low. Selling low a lot of times doesn't work out, but it could keep going lower. So again, I think what they are doing long term, I'm sure they will find a way to see better results, but we don't know when they are going to start turning that stock around, especially with class action lawsuits, which can drag out for long periods of time. Maybe super long term, they'll be okay as long as they don't blow all their money and don't lose funding. But right now, like for me specifically, I wouldn't want a part of it yet. I also think I have enough in the AI department in my portfolio as it is. And of course, none of this is financial advice. Please do your own research, and everybody's in a different situation. And so some investments make more sense for others than they might for me.